Hi friends, I'm now going to upload a video on Jan 26 RTP for AFM. First few pointers from my side. Some of these questions I will solve it. You will also solve along with me. Some question I'll only be solving. You will be in listen mode. And some question only small discussion will happen. I have categorized them into three different types. One where we will do, one where I will alone do, and one where I'll just discuss the answer depending on what I found is critical, what is not critical. So, and one request from my side is you please go through the RTP question fully before I start solving it. So you go through the question, pause the video at that time, go through the question fully. Once you are done with the question, reading the question, then you can go through my explanation. And if you are confident, you can also solve it and then go through the explanation. That depends whether you're confident on your concepts or not. Not confident, no problem. Go through the explanation which I am giving you without even solving at your end. So solving or not solving, I leave it to you. But first go through the question. Go through the question. Clear? This is first main instruction which I want to give, because without this you will not be able to follow the discussion properly. Second, if you're confident about few questions, I'm giving you detailed timestamp. You can just refer questions which you are not confident on. If you're not sure about some question, just refer answer to that. If you're confident of something, you can leave it. That I leave a choice to you. Clear? With this, now you will start seeing question 1 onwards. Yeah, have a great learning, friends. Okay, let's start with question 1, friends. Gromore Limited and NBFC is in the need of funds, and hence it sold its receivables to MAC Financial Corporation for 100 million. MFC then created a trust called General Investment Trust, through which it issued securities carrying a different level of risk and return to the investor. The structure also permits GIT to reinvest surplus funds for short term as per the requirement. MFC appointed a third party called Safeguard Private Limited to collect the payment due from obligor. Who is obligor? I'll explain, and pass it on to GIT. It will also follow up with the defaulting obligor and, if required, initiate appropriate legal action against them. Based on the above scenario, these are the questions. So this is a question on securitization. Let me put a quick diagram. If you want, you can also draw the diagram with me, friends. Else you be in listen mode. That's okay. There is a grow more limit. It it sold receivables. It sold receivables to MAC Financial Corporation. Then MFC formed a trust called GIT. This GIT is technically called a special purpose vehicle. MFC sold its receivables, created a trust called GIT, and this GIT issued securities to investor, and the MFC also appointed an agent called SPL. Now, what is a securitization is somebody would have given loan to people. Example, ICICI Bank. Here, that is Gromore Limited and NBFC. It gave loan, housing loan, education loan, personal loan to a lot of people. They are called obligors. So I have given loan to so many people, housing loan, education loan, personal loan. I am the Gromore Limited. I have given loan to so many people. Now these loans, I'll be collecting money on a yearly basis, and these loans in my balance sheet, Gromore Limited, it's an asset. Now I don't want to collect this money over the next 5 years, 10 years. I want immediate money. So I sold this asset, the receivable, to MFC, MAC Financial Corporation. I told them, you please take care of this receivable. I don't want to take care of this receivable. You give me some money today. So they paid me some 100 million. I think they sold the receivable rupees 100 million. So I got my money. I am ICICI Bank. I have given loan to so many people. I have taken a housing loan. You have taken a housing loan. So many people took a loan, And Growmore Limited said, no, I don't want this headache of collecting money for a very long period. I pass on this asset to MFC. MFC creates a trust called GIT. Now this GIT is technically a special purpose vehicle. They will have one inflow and one outflow. What is inflow? From the investor they will receive money. From the investor they will receive the money and pass on this money to MFC. MFC would have passed on this money to GM Limited. Now let's understand what happens in GIT. Now if you prepare GIT balance sheet, they will have investor in the liability side. Investor are the people who are giving money, the technically equity capital, like that you can understand. And in the asset side they'll have personal loan, housing loan, education loan, whatever asset came from this. This is the balance sheet of GIT. What GIT will do, year on year, they will collect money from these people. They'll collect money from these people and pass on a part of the money to the investor after meeting their expenses. This is what a securitization transaction is all about. In a securitization transaction, GM Limited, Growmore, transferred it to MFC. MFC transferred it to GIT. GIT issued securities to the investor, got money from them, paid that money to MFC, that paid to GM Limited. And now with these assets, I'll be collecting money. Who will collect the money? There is a party who will collect the money. It's called as receiving and paying agent. A receiving and paying agent, his job is to collect money from these people, the obligor. So if you look at MCQ 4, Safeguard Private Limited is a receiving and paying agent. Their purpose is to collect money and receive money from these obligor. The obligor are the people who will receive and pay money to Safeguard Private Limited. The job is to receive and collect money. General Investment Trust, as I said, it is a special purpose vehicle. Originator is little tricky. I believe the originator is basically the person who initiates the transaction and who has these housing loan, education loan, and personal loan in their balance sheet. So ideally should be Growmore Limited. ICI has taken it to be Mac Financial Corporation. I have my own doubts. I feel Growmore is the right answer. ICI has taken it as Mac Financial Corporation. ICI logic, if I have to give, Growmore Limited is out of the scene now. It's only Mac which is there. If that is the logic I take, Growmore sold it to Mac. Mac waited for a year or two and then did all this. Then Growmore is out. Mac is the originator of the transaction. They create an SPV. I feel it is Growmore Limited. I checked with few people, but ICI has taken Mac Financial Corporation. Now, question 5 here. Question 1 I made to discuss. Question 5 is general relationship between yield and price, which we learn in our chapter on your security valuation. Yield and price has inverse relationship. Yield goes up, price will go down. Yield rises, price rises, wrong. Third one, yield falls, price falls, wrong. Fourth one, yield falls, price remains same, wrong. What is right is yield rises, price falls. This is nothing to do with securitization. This is a concept in your security valuation. Yield and price has inverse relationship. We saw it as part of bond valuation. Okay, only question pending. The securitized instrument issued for 100 million by the GIT. GIT will have to issue something to the investor, like we issue equity share and preference share. Something has to be issued. Now, there are technically three parts. There's something called as PTC, pass through certificate, PTS, pay through security, and stripped security. These are the three types of instrument which are there in a securitization transaction. If you go through the concept of securitization, I've discussed it in 1 hour in my YouTube channel. That is part of my theory video. There you'll understand. But here, what is pay through security is pass through certificates is, in a pass through certificate, very simple. In a pass through certificate, there is an income and there's a payment. Payment to whom? Investor. I collected 100. I'll pay 80 to the investor. 20 is my expenses. I collected 150. I'll pay 130 to the investor. I collected 200. I'll pay 160 after meeting the expenses. That is called pass through certificate. Whatever comes, you please pass it through. PTS means income and payment. Income 100, I'll pay only 20. 150, again I'll pay only 20. 200, again I'll pay 20. 10, again I'll pay 20. If I receive more from my, that is the obligor, when I collect the housing loan, personal loan, some prepayment and all they do, if I collect more money, I will reinvest them for a temporary period. I can reinvest it for a temporary period. That is called pay through security. You do not pass on the full funds to the investor. You can reinvest it for a shorter period. Flipped security means you can split it as income only security, principal only security. That is, whatever the GIT receives, it can receive cash flow from the income, cash flow from the principal. That is principal payment by the obligors and all. Income only security, income cash flow will be passed on. Principal only security, principal cash flow will be passed on. So which is not there. Here the question said you can reinvest the surplus fund. If you can reinvest the surplus fund, it is called pay through security. Pay through security. So if you see the answer, PTS allows to reinvest. ICI solution is wrong. They have updated MAC Financial Corporation. I still feel some logic can be there in ICI answer. If somebody says Grow has given it to MAC and MAC Grow is out of the scene. Special purpose vehicle, receiving and paying agent, and yield to maturity in market rises, price of security tend to fall. With this, our question 1 discussion gets over. Okay, I move to the next segment, which is called netting. Now, netting is a very simple term, self-explanatory term. What does netting mean? Let's understand that. Netting is, I have to pay you 50,000 rupees. You have to pay me 30,000 rupees. In practical world, I will not give you 50,000. You will not give me 30,000. What people will do? They will net off the amount and pay the net amount. Now, how does netting is useful in this case? In case of Forex, let's assume I have a supplier from whom I buy. I also sell to him. I also sell some product to him. I have to give him $1 lakh. He has to give me $80,000. We net off the amount. When we net off these amounts, what will happen indirectly is my risk will go down, because earlier I was having risk on $1 lakh separately, $80,000 separately. Receivable also has a risk. Payable also has a risk. I just want this risk to be reduced. How do I reduce this? I just set off dues receivable are set off against dues payable, and net amount is settled. I'll just settle the net amount. The payable is set off against the receivable, and only the net amount is paid by us. This is what is called netting. The process of netting is very simple. You net off the receivable with the payable. The end objective is to eliminate the risk. Now, if only two parties are involved here, it's called bilateral netting. What is two parties is? Let's assume there is a B. I am the A, I am the company, and the other party is B. I have to pay 1 lakh. I have to receive 60,000. We do netting. So net now I have to pay 40,000 to B. Any currency does not matter, whatever be the currency, I have to pay 40,000. So A net amount is now to B is 40,000. B has to pay to C. B has to pay to C 30,000. C has to pay to me. C has to pay to me some 20,000. So here I will do something called as multilateral netting. I will tell B that you have to pay 30,000 to C. You have to pay 30,000 to C, and C has to pay me 20,000. So I tell this guy not to pay me the money, and B will pay 20,000 lesser to C. B will pay 20,000. See, I have to pay 40,000 to B. B has to pay 30,000 to C. C has to pay 20,000 to me. So I tell C not to make payment to me, and I will pay 20,000 lesser to B, and B will pay 20,000 lesser to C. Everybody will deduct 20, 20 and 20. I deduct 20 from my payment as well as from my receipt. B deducts 20 from his payment as well as his receipt, and C deducts 20 from his payment as well as his receipt. In this process, the risk further goes down. The risk further goes down. Multilateral netting is little difficult to do because finding out a party like this and then telling that I have to receive, you have to pay, all these adjustments can become little difficult. Multilateral netting means more than two parties, more than two party. A has to pay to B, B has to pay to C, C has to pay to A. In this process, whatever is the lowest amount, just knock off the lowest amount, just knock off the lowest amount, and then the transaction can happen. For doing multilateral netting, practically only one option is there: group companies. If there are group companies, it is possible for us to do multilateral netting. Otherwise, doing multilateral netting is kind of difficult. It is kind of difficult to do multilateral netting. Clear? Able to understand this? A has to pay to B, B has to pay to C, C has to pay to A. I am telling B that I have to pay you, you have to pay to C, C also has to pay to A. Why not knock off the common amounts? So the lowest amount was 20,000. We knocked off the lowest amount 20,000 from C to A to B, B to C. Everyone is happy with this because nobody is losing anything here. And my liability is going down, my asset is also going down. What I was to pay was my liability, what I was to receive my asset, everything is going down. After netting, what will happen? A will pay 20,000 to B, B will pay 10,000 to C, C will not pay anything, C will not pay anything. A will pay only 20,000 to B, B will pay 10,000 to C, 10,000 to C. Clear? Able to understand this? This is called multilateral netting. Now, what is the objective of this? By doing netting, my forex exposure goes down. If forex exposure goes down, risk automatically goes down. Risk automatically goes down. Any doubts on this? First, you have to do bilateral netting. After doing bilateral netting, there is a possibility of doing multilateral netting. We will do multilateral netting. What is multilateral netting? Is combining multiple companies together and then doing the process of netting. Any doubts on the concept here? Come to page 519, page 519, question 9. It's a in the end we have MCQ based questions which have come in MTPs or RTPs. This is a very good problem to discuss netting. A simple question only, but a good problem to discuss netting. More than the descriptive question, I feel this is a better problem. Page 519, page 519, question 9. A US parent company has subsidiaries in France, Germany, UK, and Italy. Amounts due to and from the affiliates, due to and from the affiliates, is converted into a common currency, US dollar. The data is here. France is a receiving affiliate in the this side, and in the column heading is the paying affiliate. So France will have to receive. How to read the table? France will receive 80 from Germany. France will receive 80 from Germany. France will receive 120 from UK. France will receive 200 from Italy, and put together 400 is the receipt. This word India is wrong here. It should be total. I think by mistake I've added the word India there. Total. Okay. So France will be receiving 400, paying 480. Receiving 400 and paying 480. Paying affiliate is here. So paying affiliate 480, receiving affiliate 400. France. Same way Germany 360 receiving, 260 payment. Different companies are there. Then UK 420 receipt and 320 payment, and the last company Italy 380 and 500, all put together 1560 is the receipt, 1560 is the payment. It's like A has to pay to B, B has to pay to C, C has to pay to D, B has to pay to A. So a lot of transactions have been given. They have already given a table form. Instead of giving a table form, I can give words, you have to convert into table form. They have already given the table. Then they're saying treasurer of a US parent company is suggesting that by applying multilateral netting, the company can save lot of transfer or exchange cost. Every time you transfer money, there is a bid and ask loss which happens. Here, they have already converted into a common currency. You will see a similar question in the descriptive. Not exactly, this is a very comprehensive problem where there are other currencies. First job is to convert that into a common currency. Then only you can do netting. So here they have converted. I want you to repeat the same table in your notebook. After this, in the table, I'll be writing something like 0, 80 something. So I need more space to write maybe 2 or 3 more numbers. Netting will be done that way. So repeat the table in your notebook, but have space. I'll be doing something like this: 120 slash 40, 160 slash 40. So I need space for writing that extra part. So you open the table, but have space. Have space for writing exact same table. You repeat exact same table. Particulars. You please copy the exact table. France, Germany, UK, Italy. France, Germany, UK, Italy, and total. Clear? Any doubts on first the table? We've just put the table as given in the question. This is how ICI MCQ questions will be. First, you have to solve the problem. The requirements are there. I've not even read the requirements, but more or less, if I do the netting, I'll be able to answer the requirements. So every question which we have done in different places will come in the form of MCQ. This question we will be doing again. This question is a forward contract question. This is how MCQs will be in exam. This question we did in an area called EVA, economic value added. Same question we have done. Same question we did it as a descriptive problem. This is in an MCQ form. Some theory related questions can be there. This we did in an area called convertible instrument valuation. So every question will be like only this. You will have to just do it like a description. So many students ask, does MCQ need separate preparation? No, you cannot prepare separately for MCQ. You just need to go ahead with whatever you do in descriptive preparation. In fact, MCQ makes it more easier because if I even make some small calculation mistake or rounding of errors, all those issues will not come because I have one of the choices to take. Now let's do netting here. Now this is the receiving one and this is the paying one. France has to receive 80 from Germany. France has to receive 80 from Germany. Germany has to receive how much from France? France has to receive, I want participation. France has to receive 80 from Germany. Germany has to receive 120. We net off slash 40 net off 120 slash 40, 120 slash 40, and 80 slash 0, 80 slash 0. Clear? France has to receive 120 from UK. France has to receive 120 from UK. UK has to receive how much from France? 160. Net off 120 amount will net off. 120 we will net off. Able to understand this? France has to receive 80 from Germany. Germany has to receive. The first row is the receiving country. France 80 from Germany. Germany 120 from France. This side now net off. 120 will become 0 and 160 will become 40. 160 will become 40. Any doubts on this? France has to receive how much from Italy? And Italy? Exact knockoff. Exact knockoff. 200 will become 0. Exact knockoff. 200 will become 0. This part is netted off as of now. This part is netted off. Now we will move to this part netting off. We will move to this part netting off. The first row, first column is netted off. First row and first column netting off is done. Germany will receive 80 from UK. Germany will receive 80 from UK. How much UK will receive from Germany? 120. 80 will become 0. 80 will become 0 and 120 will become 40. 120 will become 40. Germany will receive how much from Italy and Italy will receive how much from Germany? Germany will receive 160 from Italy and Italy will receive 60 from Germany. So 100, 0. 100 and 0. Any doubts on this? Now this netting is also done. Now only one netting is pending. UK will receive how much and Italy will receive how much? 140 and 120. So let's make the 140, 20 and 120 0. Now put the total of the net number. Okay. Now put so the total is 480. After knocking off, it is 80. After knocking off 40 plus 40, 260 after knocking off 40, 320 after knocking off is 0, and 500 after knocking off is 120. This side total 400 after knocking off is 0, 360 after knocking off is 140, 420 after knocking off is how much? 100, and 380 after knocking off is 0, and the total after knocking off is 240. Any doubts in this? So earlier so many payments were to be done. Now very simple. Germany will receive 140, UK will receive 100. Germany will receive 140, UK will receive 100. France will pay 80, Germany will pay 40, and Italy will pay 120. This till now is called bilateral netting. Now I may do a multilateral netting. Now I may do a multilateral netting as well. Till now we have done only bilateral netting. One against the other we cancelled. One against the other we cancelled. Now Germany is going to tell, Germany is going to tell that I have a 140 receipt. I also have a 40 payment. I also have a 40 payment. So somewhere I want to knock off this 140 receipt and 40 payment. Somewhere I want to knock off this 140 receipt and 40 payment. Somewhere I want to knock off this 140 receipt and 40 payment. Otherwise, France only payment is there. France only payment is there. UK only receipt is there. Italy only payment is there. German company alone is saying I have a receipt as well as a payment. I have a receipt as well as a payment. Can you please knock off that also? And then final amount, let us pay or let us receive. So I want this to become 0. I want this number to become 0. 260, 40 to become 0. How will it become 0 is I want to make this 0. I want to make this 0. When I make this 0, UK company will have some adjustment and some other company needs to have an adjustment. I'll have to adjust it at 2-3 places. That is called multilateral netting. Now below the table, net amounts after netting. Net amounts after netting. Entity, receipt, payment, net amount. Receipt, payment and net amount. Receipt, payment and net amount. France, Germany, UK, Italy. France receipt is 0, Germany 140, UK 100, Italy 0. 0, 140, 100 and 0. 0, 140, 100 and 0. Where are these numbers coming from? These numbers are coming from this place. These are receiving companies. Paying companies is in the down 80, 40, 0, 120. Net amount is receipt minus payment. 0 minus 80, 140 minus 40, 100 minus 0, 0 minus 120. Net all this transaction are just closed in this. France will pay 80, Italy will pay 120, Germany will receive 100, UK will receive 100. That's all. Everything is over. France will pay 80, Italy will pay 120, Germany will receive 100, UK will receive 100. Everything got over. Everything got over. So many transactions were there. Net answer is just receive 100 by Germany, 100 by UK. France will pay to one company. Italy will pay to two companies, 100 to one company, another 20 to another company. This parent will tell who has to pay to whom, or parent could be sitting in between. I collect 100 and 100, pass on 80, that is collect 80 and 120, pass on 100 and 100. Any doubts on this? Any doubts on this? So here write 80 in bracket payment, 100 in bracket receipt, 100 in bracket receipt, 120 in bracket payment. Clear? This is what is the net settlement which is going to happen. What is the benefit of this? So many transfers were avoided, exchange issues are avoided. So earlier 15,60,000 transfers should have been done, 1560 in thousands. Now only 2 lakh transfers are required. Now only 2 lakh is to be transferred, 1 lakh by one company. So 1 lakh receipt by one company, 1 lakh receipt by another company, 80,000 payment by one company, 1 lakh 20,000 payment. Otherwise, I should have paid 15,60,000. I should have paid 15,60,000. Now let's look at the MCQ. Before applying multilateral netting, it is necessary to apply bilateral netting. Answer is done. Okay, no need to now write anything. Okay, you are already done with the answer. If anything else is needed, I'll tell you to write it. It is necessary to apply bilateral netting. There's nothing like a unilateral netting and all. Before doing multilateral netting, I have to do bilateral netting. What is bilateral? Is Italy with France, France with Italy, cancellation. Through multinational netting, these transfers will be reduced to $2 lakh. $2 lakh, 1 lakh plus 1 lakh is the net receipt, 80 plus 120 is the net payment. So $2 lakh will be the transfer after doing netting. After doing netting, only 2 lakh will be transferred. The numbers are here: 100, and 100. 100 and 100 are 80 and 120. You can call 80 and 120 total are 100 and 100 total. Net amount is going to be only 2 lakh dollar. The exchange will happen only for 2 lakh dollar. Exchange is going to happen only for 2 lakh dollar. Any doubts on this? Clear? Can we proceed? Any doubts? Now tell me what is happening for France. Look at your notebook and tell me what is happening for France. Net payment of how much? 80. Okay. Look at for Italy what is happening. Net net payment of 1 lakh 20. Suppose if the transfer charges, this we will do it, well, we will write it, okay. If the transfer charges are 0.01%, 0.01% of the amount transferred, by applying multilateral netting, what will be the reduction in the cost? If you don't do netting, your cost is 15 lakh 60,000 into 0.01%. Your cost is 15 lakh 60,000 into 0.01%. By doing netting, cost is only 2 lakh. 2 lakh into 0.01%. Without netting, 15 lakh 60,000 into 0.01. Now write saving in cost. Saving in cost equal to cost without netting minus cost with netting. Without netting and with netting. Without netting and with netting. Without netting 15 lakh 60 into 0.01% and with netting 2 lakh into 0.01%. Cost has significantly gone down because we are employing netting technique. The netting technique is leading to significant reduction in cost. Without netting 1560 into 0.01%, with netting 2 lakh into 0.01%. What's the number you get? 1. This is the saving I get. I get a saving of USD 136 by doing the process of netting. By doing the process of netting, we save. Practical world, along with this bid and ask difference also we save, because one party would have paid at the ask rate, when we receive we collect it at the bid rate. So obviously there is further saving also which happens. 136 is a saving because of the netting technique. Any doubts on this? Okay, let's move to question 3. SS company is considering replacement of the existing machine with a new machine. Capital budgeting problem. Purchase price of the new machine is 26 lakh. That is the the purchase price of the new machine is 26 lakh. Life is going to be 8 years. This will help us in calculating depreciation. Company follows straight line method of depreciation on the original investment. You have to charge depreciation on the original investment. Scrap value is not considered for the purpose of depreciation. Other expenses, there's an installation charge, fees which is paid to the consultant, and an additional working capital. The written down value of the existing machine and the salvage value is 12,500. The dismantling of this machine, the old machine, will cost us 4,500. Annual earning before tax but after depreciation from the new machine would amount to 3 lakh 15,000. Income tax rate is 35%. Company's required rate of return is 13%. You are required to advise on the viability of the proposal, where they have given present value interest factor and present value interest factor of an annuity. I give you a minute or two to go through the question. Please go through the question. Okay, let's go step by step. Our step 1 is initial outflow, where we will write the capital expenditure of the new machine and some salvage value of the old machine. Working note 1, write along with me. Working note 1, initial outflow. Initial outflow, particulars, amount. Initial outflow, particulars and amount. particulars and amount. They have mentioned that there is a new purchase price which is called capital expenditure, purchase price of new machine, negative 26 lakh, capital expenditure. And in order to buy the machine, I have incurred two more expenses. One is installation charge and a fee paid to consultant. Now, this fee paid to consultant is little tricky because I incur this for the purchase of new machine. I can assume it to be a sunk cost. Also, what a sunk cost is, this already this fees is paid and incurred by the organization, now deciding whether to buy the machine or not buy the machine. Even if you don't buy the machine, this fees has to be paid, and even if you buy the machine, the fees has to be paid. So the advice is already received. Technically it can be treated as a sunk cost. Sunk costs are considered as irrelevant. ICA has taken it to be relevant, so we'll follow the same thing. Installation expenses 9,000. Fees paid to consultant, again a relevant expense, 6,000 rupees. Working capital increase, additional working capital expenditure, working capital, two outflows will be there, additional working capital 17,000, and NSV of old machine. NSV of old machine, net salvage value of old machine. NSV of old machine, technically the net salvage value of the old machine will come into picture, which is basically I'll sell the old machine today. How do we calculate NSV? You have seen all of this in our regular videos. Sale value, book value. First we capture these two, existing machine, the old machine. Sale value and book value. The sale value of the old machine is, cash salvage value is 12,500, but there's a problem. You incur some dismantling cost. So 12,500 net of 4,500. Net of 4,500, you will get only 8,000. 12,500 net of 4,500. Book value, written down value 76,000. There is a capital loss. Good. If there is a loss, 68,000 loss, I save income tax. On capital loss, I'll be saving income tax. There's a loss which has happened. Tax saved at, some tax rate would have been given in the question, 35%. Tax saved at 35%, and put together NSV, sale value plus or minus tax. So negative 31, sorry, positive 31,800. Working capital is negative, sorry, that is outflow. This is inflow. Initial outflow, this is my net outflow today. Initial outflow 26 lakh 200. Initial outflow is 26 lakh 200 rupees. That is the initial outflow I have from the project, 26 lakh 200 rupees. Then working note 2, in between flow, particulars, calculation, amount. In between flow, that is from first year till 8th year, we will earn something out of the project. The purpose of doing the project is to earn something from the project from first year till 8th year. From first year till 8th year, and question is said, the annual earning before tax but after depreciation. Before tax means EBT. Depreciation is subtracted. So it is PBT is given 3 lakh. I think 3 lakh 15,000 would be 3 lakh 15,000. The annual earning of the new machine would amount to rupees 3 lakh 15,000. That is the earning I'm going to get out of the machine. PBT 3 lakh 15,000 less tax at 35%. Tax at 35%. PAT, add back depreciation. Depreciation is already subtracted. Now ICI has considered the cost of the machine to be 26. Installation expense logical 9,000. Even fee paid has been capitalized by them. Depreciation is on 26 lakh 15,000, 26 lakh of capex, 9,000 of installation expense, 6,000 of fees paid to the consultant. 2615 by 8. 2615 by 8. CFAT, cash flow after tax. 5 lakh 31,625 for year 1 to 8. For year 1 to 8, 531,625. 531,625 is the in between cash flow from first year till 8th year. From first year till 8th year. That's all. Working note 3. Terminal flow. Terminal flow we write recapture of working capital. Whatever was blocked as working capital will come back. We had blocked 70,000 will be released after 8 years. NSV, the new machine which we purchased does not have any scrap value. Scrap value is not considered for the purpose of depreciation, they said, and there is no scrap value also. So 0. This is my terminal inflow. That's all. With this, we complete the NPV calculation. You consolidate. What is consolidation? Year 0 outflow from step 1. Year 1 to 8 inflow from step 2. Year 3 terminal inflow. NPV is negative. Project is rejected. NPV is negative. Project is rejected. Very simple question. NPV became negative. We are not going to go ahead with the replacement of the machine. Okay. This is a usual question which ICI asks on buyback. Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27 percentage of it to the shareholder, which means the buyback size is rupees 27 lakh. Buyback size is 27 lakh. The company decides to buy back share. Finance manager estimates that the share price after repurchase, that is after buyback, is likely to be 10% above the buyback price if the buyback route is taken. That is post buyback. Post buyback price will be 10% more than the buyback price. 10% more than the buyback price. Number of shares outstanding at present is 10 lakh. EPS is 3. So today profit after tax is 3 into 10 lakh. 3 into 10 lakh. You are required to determine price at which shares can be repurchased if market capitalization should be 210 lakhs after buyback. What is the meaning of market capitalization? Market price after buyback into number of shares after buyback into number of shares after buyback has to be 210 lakhs. Number of shares that can be repurchased, that depends on my buyback price. Impact on EPS, assuming net income is same. I know real answer, final net answer is EPS will improve, but we have to calculate the number because net income is going to remain same. Net income is going to remain same. So profit remains same. Number of shares go down. Number of shares go down. Obviously, EPS is going to improve. Now here, I don't know the existing price. I don't know the existing price. We are not going to get into that calculation because that data is not there. The question is saying buyback will happen at some price, and after buyback, the share price has to be, that is the share capitalization. The capitalization has to be 210 lakhs. Has to be 210 lakhs. Let's do this. Point number A, buyback size. Buyback size 100 lakh into 27%. 27 lakhs. 100 lakh into 27%, 27 lakhs. Point number B, buyback price A. I don't know the buyback price. Buyback price is A. Number of shares bought back. Number of shares bought back. We don't know the buyback price. Number of shares bought back. What will be the number of shares bought back? 27 lakh divided by A. Now, why I did this is 10 lakh minus this number is the shares after buyback. 10 lakh minus this number is shares after buyback. And price after buyback is 1.1A. Price after buyback is 1.1A. Multiplication of that is 210 lakhs. Multiplication of that is 210 lakhs. Shares after buyback. Shares after buyback 10 lakh minus 27 lakh divided by A. 10 lakh minus 27 lakh divided by A. Shares after buyback. Shares after buyback is 10 lakh shares minus 27 lakh divided by A. This into post buyback price. This into post buyback price is 210 lakhs. This into post buyback price into, that is what is market capitalization after buyback is shares after buyback into the post buyback price, into the post buyback. Point number E, post buyback price 1.1A. Multiply these two, it is 210 lakhs. You will get to the answer to A. Multiplication of these two is 210 lakhs. Multiplication of these two is 210 lakhs. You keep doing it. I am doing it in the screen. 10 lakh minus 27 lakh by A into 1.1A equal to 210. Solve this, you'll get the answer to A. Market capitalization after buyback means number of shares after buyback into the post buyback price. 21.79 is the buyback price. That's not the post buyback, that is the buyback price. 21.79 is the buyback price. Any doubts on 21.79? This is the price at which buyback will happen. I have no idea what is the existing price. I'm not getting into that calculation. 21.79 is the buyback price. Any doubts on this? Are you getting these numbers? We could have done it like this in lakhs. It would have become simpler. Rather than doing so many numbers, I could have done this as lakhs. 1.1A is equal into 10 minus 27x. 10 minus 27 by x is equal to 210. We could have done this like this also. Net answer is 21.79. Net answer is 21.79. Any doubts on 21.79? Can we proceed? Tell me the answer to part B. Beyond this, it's very simple. Part B, tell me the answer. Participate, guys. Any doubts on part 1? Any doubts on 21.79? Everyone got the number? Number of shares that can be repurchased is 27 lakh divided by 21.79. 1 lakh 23,910. 123,910. EPS will improve here because net income is remaining same. Net income is remaining same. Ideally, PAT will not remain same. You will see a problem on that in some time. PAT will not remain same. Ideal scenario, PAT will not remain same. Question is saying PAT is going to remain same, which is a very rare scenario. Very rare scenario. Close part 3. On EPS, if net income is going to remain same. You keep doing it, refer screen if you want. They've not given the current market price. It doesn't really matter. If that was there, we would have said how much benefit is coming. Benefit will happen because of buyback. Any doubts on this? EPS is improving here. EPS is improving here. Reason is very simple. PAT remains same. PAT remains same. Number of shares is going down. Number of shares is going down. Any doubts on this? Can we proceed? A hypothetical company ABC issued a 10% debenture of the duration of 10 years, currently trading at 850. Bond is convertible. You ignore this line for the time being, okay? You ignore this line because you will understand this when I do hybrid bonds. Ignore this for the time being, but still there is a reason to calculate. Question wants calculate the spread of yield of the above bond from this comparable bond if equivalent yield is 11.80%. Now you have read this. Tell me what is the requirement here. What is the requirement according to you? Spread of yield of the above bond from the comparable bond if equivalent yield of the same is 11.8%. What is the meaning of this? What should I calculate here? Not a very tricky one. You will have to participate. Right, wrong doesn't really matter for me. At least participation is needed. What would this mean here? Okay, what do you mean by the word spread? What normally spread means? What would the word spread normally mean? No, not life of the bond. Spread over life is okay, but what will spread normally means? Okay, first I'll tell what does spread normally mean. You see here, no? Spread over 2-year MCLR. Spread is the extra add-on or subtraction from a rate. Spread basically means gap between two rates. Gap between two rates. So I said inflation 6%, government is paying 7%. That extra 1% is the spread they are paying. Extra 1% is the spread they are paying. So spread basically means something extra or something lesser. So what does spread mean here is I will calculate YTM of my bond. and YTM of comparable bond is 11.8. YTM of comparable bond is 11.8. How will I calculate? Using 11 and 13. Using 11 and 13, I'll calculate what? YTM of my bond. I'll calculate YTM. Will it be 11.8? May not be. It could be more or it could be less. That gap is called spread. That gap is called spread. You see the word here. Spread over 2-year MCLR. What is 2-year MCLR? This 11.45 minus 2.4%. Minus 2.4%. MCLR would be something like 9.05. On top of that, I add 2.4 or 3.9 and I get the interest rate. I get the interest rate. Again, spread over 2-year MCLR. The spread is different for different types of loan. For corporates, it is different. For some central government, it is different. For some defense employees, it is different. So something they have done. Something they have done. Spread is basically extra or lesser. Extra or lesser. So what happens here is they are saying spread of yield. What is spread of yield? Yield of my bond as compared to the yield of other bond. Yield of my bond as compared to what? Yield of other bond. Able to understand the concept? Is the concept clear? What is spread? Spread basically means today, normally what happens in a financial world is I'll ask the bank, what is the spread today? Spread means what is the extra you're going to charge on the interest rate? What is the extra you're going to charge on the interest rate? I know RBI's interest rate, or I know the MCLR rates. We have certain benchmarks. I'll discuss all this as we proceed. But if you're interested, just read about spread over in benchmarks. Multiple interest rates, there will be a spread, extra add-on. Home loan will have lesser spread. The personal loan will have higher spread. So in the same example, in the same thing, if I go to home loan interest rates, let's see if I get home loan here. The 2-year MCLR is given here in the top, 9.05. 2-year MCLR is 9.05. On top of 9.05, I'm adding something extra. I'm adding something extra. Just give me a minute. SBI home loan rates. Home loan is 8.5 to 9.65, and there are multiple variants. The base variant is 8.5 to 9.65. How did they decide? RBI repo rate plus spread. RBI repo rate of 6.5% plus there is a spread of 2.65%. RBI increases the repo rate, home loan interest rate will go up. Home loan interest rate will go up. Spread basically means, normally spread is add-on, but it can be minus also. It can be minus. Spread basically means difference in two interest rate. Difference in two interest rate or two returns. You are earning 12%. I am earning 14%. So I have a spread of extra 2% over your return. Clear? So in this question, again, I'll write year cash flow. At home, you will do the YTM and find out the difference. Find out the difference. Spread of yield. Now write spread equal to question 69. Gap in interest rates / YTM returns of two bonds. It's not only bond, it can be anything. Okay, here I'm talking about bond. YTM of comparable bond. YTM of comparable bond 11.8%. Comparable bond is 11. So what should be the YTM of my bond? Ideally, it should be same 11.8. It should be same 11.8. But question is saying there is some spread. YTM of our bond? Question mark. Year cash flow, PVF, DCF. YTM of our bond? Question mark. The term spread, again be very clear. Term spread basically means how much extra or lesser. How much extra or lesser as compared to another rate. In this question, ignore this line which is there. You just ignore this. Doesn't really matter. Doesn't really matter. Ignore this. Year 0. Year 0. Year 0. It will be PVF at 11% and 13%. Question has said 11 and 13. PVF at 11 and 13. How much is the price we are paying today? Minus 850. 1 to 10 years at the end of year 10. 1 to 10 years at the end of year 10. Again repeating, I will not do YTM calculation. You do it. Spread, understand spread means gap. 1 to 10 is 1000 into 10%. Any redemption data given? Any redemption information? No. We take same 1000. We take same face value. We take face value. Now, just to complete the discussion of the problem, in that question mark write 12.76. In that question mark write 12.76. YTM of our bond 12.76%. 12.76%. How will you get 12.76? At home do 11 and 13. Do 11 and 13%. You don't do it also, I'm okay. I'm not really bothered about the IRR part. Next, spread of yield. Extra 0.96% in our bond. Extra 0.96% in our bond. Extra 0.96% in our bond. Our bond is giving extra income. Any doubts on this? The term spread basically means there is a base rate and on top of it extra. Very rare it could be minus. Very rare it could be a minus also. Give me answer to this. There are two 1.76 there. Plus 1.76. Our bond is earning more. Our bond is earning more as compared to the comparable bond. As compared to the comparable bond, our bond is earning more. Ideally, it shouldn't. Ideally, it should earn same. If it's giving extra, people will start liking this bond. People will start liking this bond. It should be extra 1.76. Extra 1.76. Spread of yield of the convertible bond from that of a comparable bond. From that of a comparable bond. It is already there in the concept, but I cannot explain all the concept at one place, so I keep doing it in question. Spread basically means the difference in two interest rate. Difference in two interest rate. In this example, RBI says 6.5. Our EBLR, external benchmark rate, for the company is 9.15. On top of that 9.15, I can charge extra also. This is a benchmark for SBI. How did they decide their benchmark? By taking RBI repo rate. Suddenly RBI increases the repo rate. You will see EBLR going up, all the rates going up. If RBI reduces the repo rate, EBLR will go down. All interest rates will go down on the loan. But FD is never like this. FD they'll give a fixed rate. Any doubts on the concept here? Clear? At home, please go through all the concepts. Complete the homework part. I'll end with this then. Let's move to question 6. STR Limited's current financial year income statement reported its net income after tax. Net income after taxes, PAT is rupees 50 CR. Following is the capital structure of STR at the end of current financial year. Debt 80 CR, equity 250 CR, invested capital 330. Following data is given to estimate the cost of equity capital. Asset beta of STR, risk-free rate of return, average risk premium. Applicable income tax rate is 30%. Estimate EVA of STR Limited in lakhs. Estimate the EVA in lakhs. They have asked us to calculate economic value added in lakhs. I give you a minute, go through the question and then I start explaining it. Okay, let's write the formula first for EVA. EVA is equal to EBIT into 1 minus tax rate minus capital employed into WACC. This is the formula for EVA. EBIT into 1 minus tax rate minus the capital employed into WACC. We'll go step by step and compute all of these items. So leave some 4-5 lines. Note 1, computation of EBIT. Question has given net income. Net income is PAT. We will reverse work and get the EBIT. We'll reverse work and get the EBIT. First, let's get the EBIT number and then we go step by step. Particulars and amount. Particulars and amount. Step by step, let's go. How will you get this? EBIT less interest, EBT less tax, EAT. EAT is given in the question, and based on this we will reverse work and get to the EBIT number. We'll reverse work and get to the EBIT number. EAT is the net income. Net income after taxes 50 crores. We are doing it in lakhs. EAT is 5,000. Tax is 30%. So this is 100. 30. EAT is 70. So 5,000 divided by 1 minus tax rate. 7142.86. 7142.86 is basically the EBT number. Interest is given in the question. 11% coupon rate. 8,000 lakhs. We are doing it in lakhs into 11%. Into 11%. 880. We are doing it in lakhs. 8,000 into 11%, 880. Reverse working. Reverse working 7142.86 plus 880. Reverse calculation. Reverse calculation. 7142 plus 880. And this was 5,000 divided by 0.7. 1 minus tax rate. Reverse working. 8022.86. So one part is taken care of. EBIT number is taken care. Capital employed is debt plus equity, but WACC we have to calculate. We have to calculate WACC. Note 2. Note 2. Computation of WACC. For WACC, I need cost of debt and cost of equity. Cost of equity is RF plus equity beta. They have given something called as asset beta in the question. This is a portfolio management chapter concept. Using the asset beta, we have to get the equity beta. They've asked for cost of equity. Asset beta is given in the question. We'll have to get to the equity beta. We'll have to get to the equity beta and then complete the solution. So here WACC part. First is in this computation of equity beta. Again, the format is something we have used extensively earlier. Source, cost, weight, product. Source, cost, weight, product. Cost is called beta here. We are calculating the beta. Source, beta, weight, product. Very simple concept. Debt, equity, and overall. Debt, equity, and overall. Debt, equity, and overall. Source, beta, weight, product. Debt normally has 0 beta. Overall is called asset beta. The asset beta here is 1.11. Asset beta is 1.11. Weight of debt is 80 CR. The weight of debt is taken as debt into 1 minus tax rate. When we do WACC, tax impact is on the cost. But when you do beta calculation, tax impact will be on the weight. 8,000 into 0.7 into 0.7, 1 minus tax rate, 5,600. Equity, 50 CR, 25,000. Put together 3,600. Put together 3600. 0 into this is 0. 5600. And this side 1.11 into 3600. Just a minute. 1.11 into 3600. 3600. 33,966. Reverse calculation. The equity number, see what is product is sum of debt and equity is overall. So reverse working 33,966 minus the debt 0, 33,966, and you'll get the equity 33,966. Second column into third column is fourth column, fourth by third is second. This will give me the equity beta. In case you want to learn this more, then my detailed concept video will help you. Here quick discussion, 1.36 is the equity beta. 1.36 is the equity beta. Now using this, cost of equity is equal to, using this, cost of equity is equal to RF plus equity beta into RM minus RF. RF plus equity beta into RM minus RF into RM minus RF. The RF is the risk-free rate is 8.5%. Market risk premium is 9. Market risk premium is 9. 8.5 plus 1.36 into 9. 9 is the market risk premium. 20.74%. This is cost of equity. Cost of debt is interest into 1 minus tax rate. Interest into 1 minus tax rate, 11% into 1 minus 0.3. 7.7%. Cost of debt is 7.7%. And now I have to do WACC. WACC is using 7.7 and 20.74. Using 7.7 and 20.74. We had asset beta, we got the equity beta. Now for WACC, same format. Source, it's a very useful format. Source, cost, weight and product. Debt is 7.7%. Equity is 20.74%. Weight now will be 8,000. It will not be after tax. After tax is the cost. After tax is the cost. Weight will not be after tax. That's all. Sum of product by sum of weight. Total is 33,000. Multiplier 8,000 into 7.7%. 8,000 into 7.7%. 616. 20.74 into 25,000. 5185. Put together 5801. Sum of product by sum of weight. Beautiful format. Somebody wants to get more clarity on this format, you just go through the video, the detailed concept video. There it is explained beautifully. 5801 divided by 33,000. 17.58%. 578. That's all. We are kind of done with the question. 17.58%. I've done two decimal. Solution, if they have done lesser decimal or more decimal, can lead to variation in answer. Now coming to this, and decimal part, don't worry. ICA exam question, they'll clearly mention how many decimal we have to work. EVA is equal to EBIT 8022.86 into 0.7. 8022.86 into 0.7 minus capital employed, debt plus equity into 17.58%. 17.58%. 5616 minus 5801.40 if I want to work with the two decimal, negative 185.40 lakhs. A beautiful question. Test your portfolio understanding as well as this and the WSEC calculation. Let's see the solution in case any rounding of differences are there. 17.5. Okay, the solution is okay, yeah, finally 185.40. That's the answer. That is the EVA answer. Any doubts you can let me know. We'll then proceed to the next question. Let's come to 27. On 1st April 2015, Sunidhi was holding a portfolio of 10 securities whose value was rupees 994,450. The weighted average of beta of 9 securities was 1.10. Since she was expecting a fall in the prices of the shares in the near future, to hedge her portfolio, she sold 5 contract of Nifty futures expiring in May 2015, which was trading at 8767 on 1st April. Calculate the beta of the 10th security, reconcile the reason in spite of 2% fall in the market if she would have earned some profit. Earning profit is very logical, can happen in case fall in one market is not exactly supported by the fall in the other market, then it's exactly supported depending on the beta. Now here what happened is I have a portfolio of 10 security. I have a portfolio of 10 security. So security, beta, weight, product. Weight is 994, 450. The headache here is the beta is given for 9 security. They have not given beta for all the 10 security. So you cannot say portfolio has a beta of 1.1. That is not logical. Portfolio does not have beta of 1.1. Only 9 securities have beta of 1.1. Since she was expecting a fall in the prices of the shares in the near future, to hedge her portfolio, she sold 5 contract of Nifty futures. So I have done sale of Nifty futures. If I have done a hedge of my portfolio, overall beta is 0. So what we will do now is security, beta, weight, product, portfolio. I don't know this. I know the weight. I don't know this also. Nifty futures 1, I know the weight, I know the product. Overall total will be 0. Overall total will be 0. Balancing figure is this question mark, and balancing figure is the beta of the portfolio. Balancing figure is the beta of the portfolio. Balancing figure is the beta of the portfolio. Okay, after that is done, then again I'll do security, beta, weight, product. 9 securities, 1 security, overall. Overall I know, 9 security I know, the 10th security is balancing figure. 10th security is balancing figure. Any doubts in this? What happened here is, normally using beta, you calculate the amount to be hedged. Here using the amount to be hedged, you reverse work the beta. You reverse work the beta of the portfolio. Portfolio consists of how many security? 10 security. In that 9 securities, I know what is the beta. 1 security, I don't know the beta. 1 security, I don't know the beta. So my job is to find that 1 security beta. Find out the beta of the 10th security and reconcile the reason why we would have made profit. Why we would have made profit. That's okay. That's more of a theoretical answer saying that market would have fallen by 2%. Our portfolio should have fallen by 2.5%. It would not have happened, or it would have happened slightly more, slightly less. That is all market issues. So that's not my worry. My worry is the first part, where again I'm going to do security, beta, weight, product. First is portfolio, second is Nifty futures. I know the weight of Nifty futures. I know everything about Nifty futures. Only thing I don't know is beta of the portfolio. Beta of the portfolio. Working note 1, computation of portfolio beta. Computation of portfolio beta. Computation of portfolio beta. Security, beta, weight, product. Security beta weight product. I'll be needing two tables, so I am showing it parallelly. First of all, let's do the first table. Security beta weight product, portfolio Nifty futures overall, portfolio Nifty futures and overall, portfolio Nifty futures and overall. Question mark, question mark. First one is question mark. Weight is 994, 450, 994, 450, 994, 450. Nifty futures 1. Nifty futures is 1. How many contracts we sold? Minus 5. Minus 5 into. Minus 5 into. What's the contract multiplier? 25. Size of one contract. Size of one contract is 8767.07. 8767.07. 8767.07. Negative 95, 884. 95, 884. Negative 1095, 884. Overall beta is 0. 994, 450. Overall product is 0. Overall product is 0. Overall product is 0. It's very simple. Do it in the table format. Automatically answer will come. Reverse working. This is 95, 884. We will work with maybe 4 decimal for the beta. $95 divided by 994, 450. How much is the beta? 1.10, 1.1020. Questions till now, using beta, you computed the amount to be hedged. Reverse working, using the amount to be hedged, you have calculated the beta. Now, what is the beta of 9 securities here? 1.10. In securities is 1.1020. 1.1020. I have to calculate the beta of the 10th security. I have to calculate the beta of the 10th security. Can I say beta of 10th security is 1.1020 minus 1.10? Can we say that? Beta cannot be subtracted like this. So now what I will do is recreate this, right? 9 securities, 10th security overall. 9 securities, 10th security overall. 9, 10th and overall. Nine securities, 10th security and overall. 9 security 1.10, question mark 1020. Okay, we don't know how much we are investing in every security. That's not given. I'm assuming equal investment in everything. That's an assumption. Okay, equal investment, which means this is 0.90 and this is 0.10, 0.90 and 0.10. 90 10, any number you can write. 90 10 also you can write, or you can divide 994 450 into 90 into 10. Wouldn't make any difference. 0.90 and 0.10 equal investment is my assumption. Equal investment is my assumption. 0.9 and zero point 0.1. Please close the table. You refer the screen if you want, otherwise close it. Using the table, I complete the solution. 1.12. That's the beta of the 10th security. We have assumed equal investment. Question could have said in 9 securities you have invested 95%, 10th security 5%, 0.95, 0.05. Or they could have said in 9 securities you have invested 8 lakh rupee, 10th security 194, 450. Whatever they say, I can do it. That doesn't really matter. 1.12 is the beta of the 10th security. Please don't leave the table as it is. After the table is done, beta of 10th security is equal to 1.12 times. Write that line. Clear? So below the table, please write the line. Whatever they are asking, please write it. Beta of 10th security 1.12 times. Any doubts on this? The other part is okay. Reconcile the reason is very simple. Main reason is contrary to the expectation of fall, there could have been a rise. That is, market fell and our portfolio instead of falling has gone up. Our proportionate movement is not there. Proportionate movement is not there. Both can lead to profits. Question 16. A future contract is available on R Limited that pays an annual dividend of rupees 4 and whose stock is currently priced at 125. Each future contract calls for delivery of 1000 shares daily marking to market. Now daily marking to market is a feature of a derivative contract. What is daily marking to market is, in a derivative contract the broker calculates your profit or loss on a daily basis and adds it to your margin money or recovers it from your margin money. That's a feature of a derivative contract. Daily marking to market is a feature of a derivative contract or a futures contract where on a daily basis broker will calculate your profit or loss and it will be recovered from your margin balance or it will be added to your margin balance. This is what practically happens. We will see margin account calculation later on. Corporate treasury bill rate is risk free rate. Given the above information, what should the price of one future contract be? If the company stock price decreases by 6%, what will the price of one future contract be? I had shown you TCS data. Originally TCS numbers were there in my the sheet. These were the original number of TCS, and when I was checking that day, yesterday when I was doing the class or day before yesterday, TCS 3786 had gone down and futures were also going down. Futures are also going down. In this question, what happened is, first line says spot is 125, you value the futures. Then the stock price decreases by 6%. Futures will approximately decrease by 6, not exactly by 6. Futures will also decrease by 6%. As a result of stock price decrease, will an investor that has a long position, what is long I'll explain as we proceed, in one futures contract realize a gain or loss, what will be the amount of his gain or loss? This is nothing to do with arbitrage. Here he took, see what is arbitrage is, you have to buy in two markets, buy in one market, sell in the other market. He has taken a long position in one futures contract. Only in futures he has done. What did he do in spot? I don't know. Nothing is given in the question. So this guy may make a profit, may also make a loss. If you do here as well as in the other market, there could be zero profit or there could be a profit if it's an arbitrage. And if it's a loss making scenario, arbitrage loss. Arbitrage loss is normally not there. But in case you enter into wrong contracts, you may suffer a loss also. So here, after first value, assuming the price is 125. Second, I have to value this 125 will go down. 125 will go down. When does it go down? They have not given the time period. So I assume it goes down on the immediate day. Immediately it goes down. Why is this critical? Because when I do the first calculation, the R will be, the time period will be 1 year. When I do the second calculation, again time period will be 1 year. Again time period will be 1 year. How can it make a difference? If they say stock price decreases by 6% in 3 months, in 3 months, then when you do the second calculation, the balance life is only 9 months. The balance life is only 9 months. What is futures valuation? Spot into 1 plus R power n in case you want to do compounding, without power n if you don't want to do compounding. Here originally R will be 1 year R because 1 year contract. In the second part, I assume it's an immediate decrease. It's a immediate decrease. If it's an immediate decrease, that is today market opened at 125, stock price went down by 6% in a single day. So again 1 year calculation. Again 1 year calculation. That is 1 year compounding is done for part 1. 1 year compounding is done for part 2 also. If the question says I want to complicate, I can only say one line. If the stock price decreases by 6% in 6 month period, what will be the price of one futures contract? Now do compounding only for the balance 6 month. Compounding only for the balance 6 month. Clear? Any doubts on this? Let's start writing this. But before writing this, let's write a table. This will make you understand it better. Write a table. Day, spot, futures. Day, spot and futures. Day 0. Day 0. Day 0. What is the spot rate given in the question? 125. Here what I want to know is 365 days is equal to question mark. You will have to do the calculation. We'll do calculation sometime. You just write 365 days equal to, what is that number? We'll do the calculation. Or year 1, whether you call 365 day or year 1 doesn't make a difference. Then on the same day 0, on the same day 0, price from 125 goes down by 6%. Price from 125 goes down by 6% on the same day, I'm assuming. If it happens over the next 6 months, then write day 180. Day 180. Because what is the use of this? From 125, I will do 365 days compounding. If it was day 180 to day 365, we will do only 6 month compounding. Day 270 to day 365, only 90 days compounding. So compounding effect will be done for 1 year even in part 1 and part 2. What is the price now? Revised price 125 minus 6% fall, 117.5. So there are two problems for you. Part 1, 125 spot price. Part 2, spot price is 117.50. There is a dividend given in the question. When is the dividend going to be paid? When is the dividend going to be paid? Have they mentioned anything in the question? No, its annual dividend is 4. When time they have given? No. Assume annual dividend is paid now. Then this is the present value, which is not our assumption. What is our assumption is dividend will be paid at the end of year 1. At the end of year 1. So I'll do 1 year discounting on the dividend. I'll do 1 year discounting on the dividend. Can I assume it will be paid immediately? Logically, assumptions can be anything, but problem silent, we take it at end of the year or end of the contract. If they say dividend will be paid in second month, 2 month discounting. Dividend will be paid in 6 month, 6 month discounting. Dividend will be paid in 10th month, 10-month discounting. Time period is not given clearly in the question. I assume it will be paid at the end of year one. At the end of year one. Clear? Any doubts on this? Now come down. Adjusted spot price is equal to, for part one, spot price minus present value of dividend. Spot price minus present value of dividend. Spot price minus present value of dividend. Part 1 I am doing. Spot price is 125. Dividend is 4 divided by 1 plus R. No power T, no continuous compounding, no monthly compounding, no quarterly compounding, just 1 plus R. What is R? 1 year R. 1 year R. 4 divided by 1 plus R. What is the rate of interest? 3.70. 121.30. Again I am doing the same thing. It is only time value of money. What you need to do now is 121.30 into 1 plus R, compounding effect, into 1 plus R. No power T, no power T, because we are not doing any compounding here. We are not doing any kind of compounding in the question has not given any reference of a compounding frequency. If there's a compounding frequency reference, I would have followed that frequency. So here now finally FFP is equal to adjusted spot price into 1 plus R. That's all. 121 into 1 plus 8%. 1 plus 8%. $131. Clear? 131. Any doubts on this? So day 365 is 131. Can you please give me the next answer? I'll wait for 2 minutes. 117.5 now the price is, not 125. It's only 117.5. Get the adjusted spot price and then do the balance calculation. 117.5. Adjusted spot price into 1 plus R, and now adjusted spot price is 117.5 minus 117.5 minus, I don't know what happened in the market, but I assume it happened in a single day. If it happens in 6 months, into 1 plus R will change. What will change is only into 1 plus R. So FFP is now 117.5 minus 3.7 into 1 plus 8%, into 1 plus 8% was the number. 122.90. Clear? Any doubts on 122.90? Can you tell me 131 minus 6% is how much? Minus 6%. and this is approximately closer to that. It will not exactly match. It will not exactly match. It will be approximately. If that goes down by 6%, this will also approximately go down by 6%. Exactly, it will not match. Exactly, it will not match. Logic is very simple. If this is going up, this will go up. If this is going down, this will go down. Any doubts on this? This is part 1, part 2 valuation. Part 3, no arbitrage here. Here they are saying, as a result of the stock price decrease, an investor who has taken a long, there are two types of position. Understand the terms clearly. Long means buying, short means selling. You have a long position means you have bought something, short position means you have sold something. Long position in one futures contract of R Limited, realize a gain or loss, and what will be the amount of his gain or loss. In a derivative contract, broker will calculate profit or loss on a daily basis. He'll calculate profit or loss on a daily basis. So what happened is, I pressed the buy button at this place. I pressed the buy button, long position. I pressed the buy button when the price was 131. When the price was 131, I pressed the buy button, and in the next day, I don't know what happened, it became 122.9. If I want, I can still continue for some more time, hoping it will recover, or if I want, I can close it and come out also. So on the next rate, it will be a sell. It will be a sell. I bought it at 131. When did I buy? I took a long position. Question is saying what? What will be the profit or loss for an investor who has taken a long position in one futures contract? You can take long position in the share also. Share means you have purchased at 125. You have purchased at 125 and sold it at 117.5. Purchased at 125 and sold it at 117.5. You took a position in the futures contract. You took a position in the futures contract. So I bought it. I pressed the buy button when it was 131 and I pressed the sell button. Whether you press or not press, I'm not bothered. You press the sell button, I'll calculate the profit or loss. You continue, next day again we'll calculate profit or loss. You continue, next day again profit. Every day profit or loss will be calculated and will be recovered from your margin balance. So this I can do it in the table form. I'll show it in the table form, but some of you are finding it a little difficult to grab it. So first let's do the logical way. This is the logical way. I press the buy button at 131 and sell button at what? 122.9. Tell me profit or loss here. Loss of whatever difference into 1000 because one contract is 1000 share. One contract is 1000 share. Now right here, buy, sell, buy and sell. You press the buy button when it was 131. I don't know what happened in the day. Unfortunately, it went down and I said I'll press the sell button now. I'll press the sell button now. I press the sell button. I'm suffering a loss here. I'm suffering a loss here. Buy button and sell button on the same day. On the same day, buy button in the morning at 131, sell button in the evening at 122.9. 122.9. Now write loss equal to 1000 into 131 minus 122.9. 1000 into 131 minus 122.9. How much? 8000. This is the loss I suffer. Unfortunately, I purchased in the futures. See, you can buy in futures market. You can buy in spot market. Just write one thing alone. Long means buy. Short means sell. Just write it in your notebook. Long equal to buy. Short equal to sell. These are technical terms. Long means you are buying something. Short means you are selling something. So, if the same question was opposite, listen. If the question had said investor has taken a short position, in that case, you press the sell button when it was 131. Now you press the buy button. Now you press the buy button and you will make a profit or loss. This buy button and sell button is what I return here in this way. If the investor has taken a long position, decrease in price will result in loss, and I could put it in the table format. How can you put in the table format? Date, position, action, reference date, wait, day 0, original position by day 365 at the rate of 131, negative 131. I come back on the same day 0. I come back on the same day 0, opposite position, sell day 365. You are selling now at 122.9. The gap is 8,100, which is technically your profit or loss, depending on if you get more money, it is profit, you get less money, it is loss. Any doubts on this? Okay, let's now do question 8. XYZ Limited issues a rupees 50 million floating rate loan on July 1, 2018 with resetting of coupon rate every 6 months equal to LIBOR plus 0.5%. So I have taken a loan where there is a half yearly reset and the interest rate is LIBOR plus 0.5%. I am interested in a collar strategy by selling a floor and buying a cap. Collar is one of the strategies under your interest rate options where we have a cap option, floor option and a collar option. Cap option restricts your maximum interest outflow. Floor option gives you minimum interest income. If you sell a floor, minimum interest expense. So selling a floor is minimum expense. Buying a cap is maximum expense. Maximum is cap, minimum is floor. 3-year cap and a 3-year floor. Notional principal amount. Reference rate, that is it is again 6-month LIBOR. 5% for floor, 8% for cap. What this means? If the LIBOR is above 8%, I will get some compensation from the other party because I have to pay very high interest. No, above 8%, if interest rate goes up, the LIBOR, not LIBOR plus 0.5. If the LIBOR goes above 8%, I will get compensation from the other party. And if the LIBOR is below 5%, I have to pay minimum 5%. I have to pay minimum 5% at a LIBOR level. Using the following data, you are required to determine effective interest paid out at each reset date. How much interest we are paying? Round off to the nearest rupee. Average overall effective rate of interest. Assume 365 days a year and 366 days for leap year. That's okay. 365 days a year and 366 days for a leap year. Now, first thing, you go through the question. I'll wait for a minute. Okay, let's start doing this now. There is a reset date given. Every reset date, I have to pay LIBOR plus 0.5. But in case the LIBOR is above 8%, I'll get some compensation. And if the LIBOR is below 5%, I have to pay some compensation. What is this floor and cap is? I have sold a floor. If interest rate is below 5%, I have to pay something. And if interest rate is above 8%, I will receive something. When above 8%, I want to receive so that I'm compensated for that higher interest outflow. And if it's below 5, I enjoy the benefit. So I pay something extra also. I'm okay to pay. When the interest rates are lesser, I am ready to pay a compensation. And when the interest rates are high, I want to receive a compensation. Now I'll start doing the working. When I do the working, there are two ways of doing the solution. I will first tell what ICA has done in this question and what is the other way also. Let's write the data given in the question. First is reset date. Reset date, which is the first column. 31/12/2018. That's the first reset. Then we have 36/2019, 31/12/2019, 36/2020. This question, I think you need not write along with me. You can just be in lesson mode. 31/12/2020, 36/2021. They gave a LIBOR rate. LIBOR was 7, 8, 6, 4.75, 4.25, 5.25. This is given in the question. Now, what ICI has taken, which is debatable, but this is what practically happens. Every reset, my reset happened on 31st December. For this reset, the payment will happen after 6 months. The reset happens and the payment is done later. That is, whenever a reset happens, that interest rate is applicable for the next 6 months. There was another question in our book material. If you go through my question bank, you will see The reset was applicable for the previous 6 months. Which will ICI follow? I have no idea. That's a challenge here. So date of payment, reset happened. The payment will happen after 6 months. That is 30th June. The payment will happen later. The payment will happen later. And I'll have to calculate the number of days here. If it is number of month, no problem. When the payment is made and all, 6 months will do. Because based on number of days, you will do into 185, 182, 183. That's the only slight issue here. The reset happens in December 2018. Payment happens in June. Then we'll have to calculate the number of days. Number of days is December happened, January 31 days, Feb 28, 31, 28 Feb, 31 March, 30 April, May 31, June 30 days. The next 6 months. Then June reset happened 31st July. Then your July is done, 31st July, August, September, October, November, December. Then reset happened on 31st December 2019, 31 days of January, leap year, 29 days, 2020, 29 days, 31, 30, 31, 30. This I think will remain same, and these two will remain same. Only these two, this is the leap year. This year is the leap year. This year part is the leap year part. So here when you do interest calculation, you have to divide by 366. 182 days, 2020 and 184 days. 182 and 184 days. Now, first I have to pay interest to the bank. Ignore the cap option, ignore the floor option. You have to pay interest to the bank from where you took the loan. From where you took the loan. How will you calculate that? Is interest paid. Interest paid. We took a loan of 50 million, which is 5 crore rupees. Just give me a minute. We took a loan of 5 crore rupees. 500, 5,000, 50,000, 5 lakh, 50 lakh, 5 crore. Just a minute. ₹5 crore into the rate of interest is 7. I have to pay 7.5. I have to pay 7.5. I have to pay 7.5 into the number of days will come into picture 181, 365, 181, 365, 181, 365, 50 crore, 7.5%. Why 7.5? 7 plus extra 0.5. Next time 8 plus extra 0.5, 8.5, and this was 184 days, 8.5 and 184 days. Next one 6.5, but 182 days divided by 366 days, divided by 366.5. Next one 5.25, 5.25, 184 by 366, 366 days. 4.25 means 4.75, 181, 365, and last one 5.75, 5.25 plus extra 184, 365. This I have to pay to my bank. I'll repeat again. 5 crore, 7.5%. This number of months means 6 by 12. No headache itself. 181 by 365, 184 by 365, 182 by 366, 184 by 366, 181 by 365, and 184 by 365. This is what you do for interest paid. Then there are two things which can happen. Cap receipt. If the LIBOR is more than 8%, if the LIBOR is more than 8%, unfortunately none. I'll not get any compensation. No receipt for me. No compensation. Cap receipt is not there. If the LIBOR is more than, not LIBOR plus 0.5, LIBOR is more than, no. Then floor payment. Cap receipt, floor payment. Cap receipt is 0. Floor payment is very simple. When will you make the payment? Floor payment is if the interest rate is below 5%. Not applicable, not applicable, not applicable. There is a problem here. I have to give compensation. It's an outflow for me. I have to pay 5, below 5 how much? 0.25. Below 5% you have to give compensation. 0.25 you have to compensate and 0.75 you have to compensate. Below 5% below. It's a very simple calculation. The same calculation, but you have to give 0.25 below 5 whatever number. Below 5 whatever number. And here same calculation. Below 5 whatever number 0.75, 0.25 and 0.75 you have to give. 181, 365, all that remains same. Nil. And this is my total outflow. What is total outflow? Interest paid, cap receipt if at all was there, minus it's an inflow, and floor payment. This is the amount I'll be paying for different time period. Overall I pay 98 lakh and overall number of days is 1096 days. 98 lakh rupees has to be paid. So you see the calculation here. 98 lakh rupees for this. What is the other option? Other option is this reset happened no 31st December. The number of days will be calculated prior 6 months. What is prior 6 months? July, August, September, October, November, December. That would have been 184. This number of days would have been 184 if you take the prior 6 months. And if you take the later 6 months, it is 181. What to do? I feel this has come in RTP, so let's follow this. So they have asked us for, one was effective interest paid and average overall effective rate of interest, round off to 2 decimal. What is average overall effective rate of interest is we have paid 98 lakh rupees. We have paid 98 lakh rupees on a loan of 5 crore. 50 million is 5 crore into 1096 by 365. Why 1096 by 365? To make it per year. We normally divide by 12 by M or number of days by 365. So 1096 by 365, 98 13,703 divided by 5 crore into 1096. Sorry, not into 1096. Sorry. Into 365 by M. 365 by days. Sorry. 365 by 1096 into 365 by 1096 into 100. 6.54%. 12 by M or 365 by number of days. 12 by M, sorry about it. 12 by M or 365 by number of days. 6.54%. You will see that in the solution. 6.54%. Loan has been taken on July 1. First payment should have been done on December 31. ICAI solution has assumed the reset to be applicable for the next 6 months. Applicable for the next 6 months. This is what ICAI has done. I have gone ahead with this in my material. If you open my workbook question bank, you will see first question. Before this, a question will be there where it will be applicable for the prior 6 months. This is a question from our book only. It's not a new question at all, but there the solution is different. And the next question, both the question are there. The way we solve is different. Clear? If there are any doubts, you can let me know. Page 190 has categorized all the available stock in the market into following types: small cap growth stock, small cap value stock, large cap growth stock, large cap value stock. So 4 categories of stocks are there. He also estimated the weights of the above category in the market. In the market is the stock market. Furthermore, the sensitivity is basically beta. The sensitivity of returns of these categories to 3 important factors. Like I said, GDP growth, here they have decided 3 important factors. Category, weight in the market, what are the factors? First factor is beta. Second factor is price to book ratio. Third factor is inflation. These are the 3 factors they have given. Small cap has a sensitivity of 0.8, 1.39, 1.35. Small cap value 0.9 sensitivity, 0.75, 1.25. Doing this calculation at least is possible to some extent, but this is the trickiest part. The risk premium or return premium for every factor. That is, for the beta, the risk premium is 6.85. For price to book, the risk premium is negative 3.5. Negative, if it's negative, let's be it negative. And for inflation it is 0.65. Determine the expected return on the market index using arbitrage pricing theory. Then using CAPM will stop at this level. RF plus beta into RM minus RF. What will our APT theory do? RF plus beta into RM minus RF plus price to book into RM minus RF plus inflation into RM minus RF plus GDP growth into RM. It's not RM minus RF, it's technically the risk premium. Then using CAPM, find out the return on the market index. Then he wants to construct a portfolio. Part C is okay. That's a very simple one. So here what I have to do is I have to find out the return of the market. What is market? Market has all this four: small cap growth, small cap value, large cap growth, large cap value. How am I going to do the calculation? First, required return of small cap growth is equal to RF plus beta into risk premium plus price to book into risk premium plus inflation into risk premium plus GDP growth into risk premium. Like this you keep going on. If you just stop at beta into risk premium, that is CAPM. But if you keep adding extra factors in the analysis, that becomes the approach of this. Clear? So I'm going to take first stock, small cap growth, do the calculation. Then small cap value, do the calculation. Then take large cap value, do the calculation. Large cap growth, do the calculation. What is return of the market? Whatever you calculated into 25, 10, 50 and 15. Into 25, into 10, into 50 and 15. Okay. What will be the difference in CAPM? In CAPM, don't add price to book in the calculation. Don't add inflation in the calculation. Remove all these two and just restrict yourself to beta. Once that is done, some portfolio creation I'll explain. Let's start. Working note 1. Computation of market return under APT. Under arbitrage pricing theory, under APT, required return under APT is equal to RF plus beta into RP1 or beta into RP. You can just call it as beta into risk premium or return premium. Here beta is first factor. Beta into risk premium. See, you can use the term risk premium or return premium. What is risk premium? Return premium, extra which you want, plus price to book beta into RP. What is beta? Sensitivity. How sensitive is our portfolio to price to book ratio? Price to book beta into risk premium plus inflation beta into risk premium. Is there an end to this? No, you can keep adding multiple factors. We have just restricted ourselves to this many factors here. Let's do the first one there. Small cap growth is equal to RF is there in the question and the sensitivity is there in the question. RPC. If somebody tells me, can you do CAPM for Infosys? Yes, I can do. Can you do APT for Infosys? I cannot do, because very difficult for me to find these 3 variables or 4 variables or 5 variables and do the RP there. So this is, though it is very comprehensive, but practical world, because we are trying for a lot of perfection, the utility got lost, because practical world it's difficult to implement it. What is the risk-free rate? 4.5 plus first factor is 0.8 into 6.85. 0.8 into 6.85. There can be a negative also. Negative means leave it as it is. 1.39 into minus 3.5. Minus 3.5. 1.35 into 0.65. 1.35 into 0.65. 5.9925%. You do the calculation, but you'll get 5.9925%. This is the return I expect from small cap growth. 5.9925%. Small cap growth is 5.9925%. Because we want to make it more comprehensive, the concept indirectly makes it more complicated. Makes it, from our point of view, see, this problem is not complicated. Practical utility is very difficult. Solving is very, very simple. There's nothing there in the question. You just put the numbers, automatically will come. Obviously, it'll take more time. Then next one, small cap value. Small cap value 4.5 plus 4.5 plus, what is the first one? Factor 1 beta is how much? 0.9 into 6.85 plus 0.75 into negative plus 1.25 into 0.65. $8.8525. Please, you keep doing it. Refer the screen if you want. The next two. Large cap growth. Refer screen if you want, else you keep doing it. Final answer, you can keep it as 4 decimal. Even 2 decimal can also be argued. To keep doing it, refer in case you get stuck. These should be the numbers. Any doubts on this? These are your numbers for the 4 categories: small cap growth, small cap value, large cap growth, and large cap value. Now, if I remove in this formula the last 2 items, it will become CAPM, and if you include this 2, it becomes APT. CAPM would have stopped at RF plus 0.8 into 6.85. It would have stopped there. APT is saying no, include price to book, include inflation, and it's not necessary that beta has to be one of the factor. Here beta was one of the factor. It can be any factors. It can be any of the factors. Any doubts on this? Return of market under APT is equal to, return of market under APT is equal to, each of this has a weight, each of this has a weight under the market index. So we are going to do a weighted average of the 4. We are going to do a weighted average of the 4. I can do it in a formula, or I can do return, that is security, return, weight and product, weight and product. That way also we can do 5.9925 into 5.9925 into, what is the weight of the first security? How much? 25% plus 8.8525 into 10% plus 8.4778 into 50%, and last one 7.535 into 15%. So we have totally 4 securities and each of its weights are available. We consider them You keep doing the calculation, it will take a little bit of time, and then check the screen. Four decimal you can work with. $7.7526 it adds up to 26 or 25, whatever number. Broadly 7.75%. Any doubts in this? Clear? 2 to 3 minutes for you. Repeat the same thing under CAPM model. Part 2 of the question. You have to repeat this under CAPM model. When you do CAPM, price to book into RP will not come, inflation into RP will not come. You have to repeat this under CAPM approach. Maximum 3 minutes for you. So coming to the CAPM part, what we need to do is we need to remove the 2 parts to the formula. Just leave the first one. Just leave the first one. So this is for the first security. This is for the second security. This is for the third security. And this is for the fourth security. These are the return numbers. You'll have to obviously multiply with the weights which we have decided. I do the multiplication and final return number is somewhere around 11.35. Somewhere around 11.35. It's a very well drafted question by ICI because this 11.35 I could have directly told, but maybe it doesn't match in some other question if they don't draft it. 4.5 plus 6.85. 4.5 plus 6.85. Why? Because that is the RM minus RF. That is the RM minus RF for the beta. RM minus RF is 6.85 as far as beta is concerned. As far as, because CAPM uses what formula? RF plus beta into RM minus RF. So directly I can say RM is 4.5 plus 6.85. Only challenge is in case they don't draft the question properly, then I can't help it. So this I'm very happy because they drafted it properly also. I could have directly done 4.5 plus 6.85, but I am not confident every time they will do draft it properly. So you do the longer calculation. That is first security, second security, third and fourth. Then Mr. Nirmal Kumar wants to construct a portfolio consisting of only small cap value and large cap growth. Small cap value and large cap growth. If the target beta for the desired portfolio is 1, target beta is 1, determine the composition of his portfolio. This we have already explained. What we do is when I want a target beta, I had the same format: security, beta, weight, and product. In that, here I'm going to create only two securities. What are the two securities? Small cap value and large cap growth. And what are the beta of these two individually? 0.9 and 1.165. Together, I want a beta of one time. Together, I want a beta of one time. Next, creation of portfolio. Creation of portfolio. Security, beta, weight, product. Creation of portfolio. Security, beta, weight, product. Weight and product. We want to focus only on two. We just want to focus on only two securities. I don't want to go beyond that. The two securities I am focusing on is small cap value and large cap growth. Small cap value and large cap growth overall. Individually, small cap value beta is given, large cap growth beta is given, overall one time. That is the requirement of the question. So see, like the target beta is 1, I can say target price to book is 1. Our target inflation is 1. Target inflation beta, our target price to book is 1. I can give anything I want. So here, this is 0.9, 1.165, put together is 1. This is A, 1 minus A, put together is 1. Weight is 1. A and 1 minus A. A and 1 minus A, put together is 1. Multiplication 0.9A, 1.165 minus 1.165A, total 0.9A plus 1.165 minus 1.165A has to add up to one time. Has to add up to one time. 0.9A plus 1.165 minus 1.165A has to add up to 1. Add up to one time. 0.9A plus 1.165 minus 1.165A has to add up to 1. You can keep solving it. Yeah, I already got the answer in live online. A is 62.26%. That is small cap value 62.26%, large cap growth is balance 37 something. 62.26%, and any reverse working, just to be on the safer side, 0.9 into this number plus 1.165 into the other number, just be doubly sure that it adds up to 1. So that check always keep doing whenever you do any reverse working calculation. This is a reverse working because from the overall beta I am going back to the individual weights. Any doubts on this? Small cap value 62.26%, large cap growth will be 37.74%. Any doubts on the two numbers? Clear? Can you proceed? Any doubts? Is there a doubt? 62.26%, 37.74%. It's a very simple concept. I don't see any trickiness in the concept per se, but yeah, calculation a little bit more time. Practical utility is on the limited side. Because finding out so many numbers here, everything is given to you. Your job was just to do multiplication, addition, subtraction, and then get to the number. Practical world, you have to find out all of this and then do Infosys calculation. It's very difficult. Any doubts on this? Can you proceed? Okay, let's come to question 10. On 1st October 2020, Mr. Guru, an exporter, enters into a forward contract with a bank to sell USD 1 lakh on 31st December 2020 at INR 85.40 per US dollar. At the request of the customer, Mr. Guru received the amount on 30th November 2020, early delivery. Mr. Guru requested the bank to take early delivery of the remittance on 30th November, that is before due date. Interbank rate on 30th November was as follow: one spot INR slash USD 1 month premium, assume 365 days in a year. Bank agrees to take early delivery. What will be the inflow? Mr. Guru can deploy these funds in USD. He gets a return of 3% per annum, which is better, and why? Assume 365 days, prevailing prime lending rate and a term deposit rate, round off calculations up to 2 decimal points. So ICA normally makes it very clear how to do the calculation up to 2 decimal point. This question is there in our workbook also. The numbers are different, so that is why I'm discussing it. Else I would have given that video itself. The numbers are different here. First, I tell you to go through the question. I give you a minute or two, go through the question. Okay, it is a question on early delivery. In an early delivery, the transaction will be assumed to be executed at the original rate, but there'll be something like a swap loss and interest to be paid. Swap loss and interest to be paid. Along with that, there's something on leading and lagging, which is part two. What is leading and lagging? How does it work? You'll understand. First, I've entered into a forward contract. I'm an exporter. I wanted to sell USD 1 lakh on 31st December at the rate of 85.40. I will write this information, whatever contract we entered. Entry date. We entered one contract on October 1. October 1, we entered a contract. We call it as what type of contract? This is original date position, original position, action. We would have taken some action saying that I want to buy it or sell it. I took an action of selling it. My sell will happen at bid rate. Whatever I sell will happen at bid rate. Bank will buy at the bid rate. And this was to be executed. There was an execution date. I had planned to execute this by December 31, and there was a rate at which I entered this contract, which is 85.40 INR, 85.40 per US dollar. This is a contract I'm entered, and I'm now happily saying that okay, contract is entered in, will be able to get this money at 85.4. This is what ideally should have happened. Now I get a surprise. On November 30, the interbank rates are given. I am requesting for an early delivery, so I have to cancel this contract. Technically, we are technically called as a swap loss computation. The contract will get executed at 85.4 as per ICI, and there's something called as a swap loss. I come back on November 30. Moment I come back, I have to do an opposite contract. Opposite position. What is opposite? Sell means opposite is buy. Will happen at ask rate on December 31 itself. On November 30, what is the ask rate on November 30? I'll have to cancel this contract. On November 30, what is the ask rate for December 31? On November 30, what is the ask rate? What is the ask rate for December? This is given here. They have given the figure. Spot INR per USD is given. Along with that, 1 month premium is given. 1 month premium 10/15. So 85.27 plus another 15. 85.27 plus another 15. 85.42 per USD negative. So I cancel this contract and swap it to the next available contract, which is today. Swap it with the next contract. Why are we canceling it? We should have ideally executed it on October 1 entry, December 31. I should have given the $1 lakh and got 85.40. Suddenly I come in between. When did I come? I came back on November 30. New position. Today I will tell them to get it. Sell at bid rate on November 30 itself. Sell at bid rate on November 30 itself. Sell at bid rate on November 30 itself. Instead of doing December 31, we'll do it as November 30. What is November 30? Bid rate is 85.22 per USD. Effectively, I was to get 85.4. Now what I'll get 85.4 cancelled with 85.42 and a new contract with 85.22. This the total last column total 85.4 minus 85.42 plus 85.22. Effectively, I will be getting INR 85.20 per USD. Effectively, I'll be getting INR 85.20 instead of 85.40. Effectively, I'll be getting only INR 85.20 per US dollar. Now, what ICI says is, you don't consider it this way. You get 85.40 and you pay swap loss. What is swap losses? Second and the third item plus or minus. Second and the third item. 85.42 negative, 85.22 positive, 20 paise outflow. Second and third item net. Second and third item net. 85.42, 85.22. Second and third item net. 85.42, 85.22. You pay swap loss of this is what I receive original 85.4 and I pay 0.20. This is how ICI presents it. Otherwise, net I receive 85.2. So, what is my net inflow is net inflow. This is as per ICI working. Okay, receipt at original rate. Receipt at original rate 1 lakh into 85.4. 85 lakh 40 inflow. Swap loss I have to pay 20 paise. 1 lakh into 0.2, 20,000 outflow, and there is something called as an interest. This I feel is not a very logical calculation, but I'll do it. Interest. What is interest is, bank was thinking that you will give the money to the bank on December 31, and he was sitting happily saying that okay, money will come on December 31, and once the money comes on December 31, I will do some back to back. I would have done back to back contract and I'll execute. But you suddenly came on November 30. So what concept? I don't agree to this working, but I'll write whatever. We give 1 lakh dollar to bank and get INR 85 lakh 40,000. We give 1 lakh dollar to bank and get INR 85 lakh 40,000. We give 1 lakh dollar to bank and get that original contracted rate. Bank, this happens on which day? November 30. Bank sells to another bank. Bank sells to another bank on November 30 at bid rate, because when bank is selling to another bank, bank sells to another bank on November 30 at bid rate. At bid rate, what is the bid rate on November 30? 85.22. 85.22. Inflow for bank 85 lakh 22,000. So now bank is cribbing, saying that I gave you 85 lakh 40. In reality, they gave me 85.20 only, but they are saying they gave me 85.40. And they received only 85.22 from another bank. 18,000 rupees 1 month in advance I forced to pay. Else I would have paid it on December 31. I paid it 1 month in advance. You give me interest. So interest is this 18,000 rupees. Prime lending rate 18%. 31 days interest they will charge. I don't agree to this working, but 18,000 into 18%. into 31 by 365. Two decimal working, 275.18, another outflow. So I will have 85 lakh 40 out inflow, 20,000 outflow and 275 outflow. So from a customer point of view, 85 40 minus 20,000 minus 275.18. Net, the net inflow for the customer is 85 lakh 19,724.82. This is what he will receive. Ideally, that is the effective rate 85.20. The interest and all is of no use, but okay, this is what IC has done. So if you see the detail working, we present it like this: 85.4, 85.42, 85.22, swap loss is 20,000, and this is interest cost calculation, and net realization for the customer is 85,19,724.82. This is early honor. Along with that, they added one more element which I'll explain: 85,19,724.82. Now I give you a minute or two, go through whatever we have done, and then I proceed to the next explanation. Okay, there's another part here, which is I get this money, I deploy these funds in US dollar and get a return at the rate of 3%, which is better, and why? Let's understand this. Now, first option is option 1, leave it in USD. If you leave it in USD, what happens? Let's understand. This is very, very good working. Particulars, calculation, amount. I leave it in US dollar. USD 1 lakh. I will execute it on December 31 only. At 85.4, no cancellation, nothing. At 85.4, 85 lakh 40,000. But I got this money on November 30. I'll deposit it and earn 3% interest. So interest income in USD, I deposited 1 lakh at the rate of 3%. 31 days, I will get this income. 1 lakh into 3%, 31 by 365. USD 254.80, 254 or 79, 25.79, sorry, 79. This money I will realization on December 31. This 254 will not be at 85.4 because I get to know today only. So this will be at the rate which are available here. There is a spot rate which is given, which is your 85.22/85.27, and there's a 1 month forward rate given, 10 and 15 basis point increase. So 85.22 at bid rate, I'll realize extra 10, 85.32, 85.32, 254 into 85.32, decimal deficit, decimal working, and overall realization is this. If I leave it in USD, if I leave it as US dollar, 85 lakh 61,738.68. Option 2, convert to INR. Inflow on November 30. I converted into INR. I got an inflow of 85,19,724.82. I incurred all those losses and all. What will I do with this? Beautiful. Assume the prevailing lending rate is 18% and term deposit 12%. 18% was the interest for that shortfall was there. Now I'll create a term deposit because I've received the money earlier. So interest income at 12%. 85,19,724.82. This is a leading and lagging adjustment into 31 by 365. I received the money earlier. at 12%, 31 by 3. This question you will understand only in case you are very clear on the concept. Else it could be little challenging. You have to go through the concept and then see the video. 31 by 365. Other questions were fairly simple. This is little bit challenging. 86 lakh. I receive 86 lakh here. I receive 85 lakh there. I'll obviously go with 86 lakh. That is, I'll encash it immediately. I will encash it immediately. If you encash it immediately, you get 86 lakh 6,555. And if you wait and encash, it is 8561. Cash inflow will be higher in early delivery. Option the same should be chosen. I will go ahead and choose the early delivery option. I will choose the early delivery option. That early delivery will have a swap loss and an interest outflow. I've explained it here. Receipt at the original rate. Swap losses, your second and the third transaction net off. And interest is nothing but you sold it at 85.4. Bank sold it at 85.22. Bank has an outflow of 18,000. On that, bank will charge you interest at the prime lending rate. At the prime lending rate. Any doubts on this? Let me know. Okay, let's move to question 11. This will just need discussion. Solving may not be needed. XP Pharma Limited has acquired an export order for rupees 10 million for formulation to an European company. I have to sell 10 million order. Company also planned to import bulk drug worth 5 million from a company in UK. So export is for 10 million, import is for 5 million. Proceeds of export will be realized in 3 months. Import will be due 6 months from now. Receipt, export is 3 months, import is 6 months. Invoicing can be done either in dollar, euro or GBP. Advice about the invoicing currency. Exchange rate calculation should be up to 2 decimal point, including the exchange rate, including all calculation, 2 decimal places. So good, again they have clarified. Now, I don't know why I have to solve this question. If it comes in exam, I have to solve it. But before solving, I'll explain the quick concept. See, export gives me receivable, gives me asset. Asset should be built in the appreciating currency. Asset should be built. Export is an asset. Asset appreciating currency. Go with US dollar. Maximum appreciation. Maximum appreciation. Annualized premium. Export US dollar. Export is US dollar. Maximum appreciation. Maximum appreciation. Export US dollar. When it comes to import, import gives a liability depreciating currency. Liability should be depreciating currency. Unfortunately, I do not find, because they have given me 3 options. Which is the depreciating currency here? INR is the depreciating currency, but that option is not there. I will go with the least depreciation. So this is for export. This is for import. Now I'll tell what ICA has done. They have first converted this 10 million into dollar, euro or pound. What rate? Again, this is assumption, because many students have asked me out. Should I take bid rate or ask rate for conversion? Logically, any of the rate can be taken. There's nothing like bid rate has to be taken or ask rate is to be taken, because in the practical world, when we are negotiating with each other, we'll decide. I think ICA has taken bid rate. There are questions where they have taken ask rate for export billing. So I divide by 87.10. This 87.10 bid rate will appreciate, the export in 3 months will appreciate at the rate of 7%. So 1 plus 7% into 3 by 12 will appreciate at 7%, 3 by 12, which is 87.1 plus this rate, you will get 88.62. Divide by 87.1, appreciate, and it will become 88.62, and realization will happen. Again, divide, appreciate, realization. Divide, appreciate, realization. I told the answer very clearly that it will be US dollar. Since USD billing will be preferred, the above solution has been presented as per ICI working. However, we can answer the question even without doing the calculation. We should opt for a billing and a currency which has maximum appreciation. Then for the import transaction, 5 million, they used ask rate. Is there any logic for bid and ask rate? No logic, because it is ideally a negotiation of the two parties. The two parties will negotiate whether they want to use bid rate or they want to use ask rate. That is purely their negotiation. Nobody can force them what rate to use. I will try to use the rate which is beneficial for me. And the other party will say use the rate which is beneficial for them. So here they have divided by 87.2, 6 months. So 1 plus 7% into 6 by 12 divided by 87.20 multiplied with 7% into 6 by 12. 6 by 12 is technically divided by 2. And here, as I said, GBP billing. Lowest outflow, GBP, and answer is very simple. Highest appreciation for asset, lowest appreciation for liability. Ideally, depreciation I want, but depreciation currency is not there. Lowest appreciation. There's a mistake here. Outflow after 6 months. This is outflow after 6 months. 51.25. So INR outflow is lowest in GBP billing. We should opt for GBP billing. Divide by the rate, increase the appreciation depreciation percentage, and then the outflow or inflow will happen. So in this case, my solution, again, above solution has been presented as per ICI working. We can answer this question even without doing the above calculation. Minimum appreciation, which is liability GBP. Clear? Any doubts on this? Any doubts on this question? Okay, we come to question 12. X Limited is studying the possible acquisition of Y Limited by way of merger. Following data are available: market capitalization value of company, GP ratio, inventory turnover ratio, debtors turnover ratio, 12% debenture, 10% debenture, number of equity share, operating expenses, CT rate, corporate tax, closing stock, debtor. So uses the concept of ratio analysis, which you would have learnt at CA Inter. We have also covered that in our security analysis chapter. You are required to calculate swap ratio based on EPS and MPS, earnings per share and market price per share, with a weightage of 40 and 60. Post merger earnings per share, post merger market price assuming the same P ratio, post merger gain or loss in EPS. Everything is fine, but there is some inaccuracy in the question, which is where I mentioned something. Data on debtors turnover ratio is wrong, and hence the same should not be given in question. Please remove that from the question. When you solve the question, you should not look at debtors turnover ratio. Technically, that is a wrong information. Ideally, should not have been given in the question. They made some error in drafting, not sure. Ideally, that information should not be there. Go through the question. Okay, let's start doing it. We'll use the debt inventory turnover ratio and then try to get to the solution. Particulars and two companies. Particulars X Limited, Y Limited. Some inaccuracies are there in the question, can't help it. Closing stock given in the question 15 lakh, 5 lakh. I'll have a merged column. This will be used for some places. Okay, closing stock 15 lakh and 5 lakh. Inventory turnover ratio. Inventory turnover ratio 5 times, 4 times. COGS. What is COGS is? Your inventory turnover ratio is COGS by closing stock, and hence inventory turnover ratio into closing stock is COGS. COGS is 15 lakh into 5. 15 lakh into 5, 75 lakh. 5 lakh into 4, ratio analysis understanding. 5 lakh into 4, inventory turnover COGS by closing stock. Then they have given GP margin. GP margin is 20%. GP ratio 20% for both. Balance is called COGS ratio. COGS is 80%, 80%. COGS is 80% of sales. Sales is equal to COGS divided by 80%. COGS divided by 80%. So sales, you can just listen to the explanation. 75 lakh by 80%. This is the sales number. Now from sales, I have been given a ratio called operating expenses. That is, if you remove the operating expenses, you will get EBIT. If you remove the operating expenses, 86 and 78. 86 and 78. Ideally, for Y limited, it has to be more than 80. I don't know why they gave this way, because your COGS itself is 80. How can overall expenses be less than 80? Operating expense means all expenses. Less operating expenses, EBIT, less interest, EBT, less tax, EAT, number of equity shares, EPS, P multiple, MPS, number of equity share, and market value. This is a format we write. You write this: sales less operating expenses, EBIT, less interest, EBT, less tax, EAT, number of equity share, you will get EPS, P multiple, MPS, again number of equity share, market value, again number of equity share, market value. Now, first company, the, the operating expenses given are merged, we'll see later, 86%, 86%, 86%. Just a minute. First company 86%, second company 78%, 86 and 78. This will give you a bit 1312 and 550. A bit is 1312 and 5 lakh 50. Interest self-explanatory. Beyond this, it's self-explanatory. You can do it along with me or just listen. 1 lakh 20, 1 lakh 44. I really don't want to explain much time now. EBT. Tax rate given in the question is 30%. EAT. Number of equity share is 1,60,000. EPS 2 decimal. We'll divide and write 2 decimal. There's a 2 decimal calculation. Divide 2 decimal. Divide and 2 decimal. 8.35, 4.74. 8.35, 4.74. EPS 2 decimal. MPS is given by market value, market capitalization. 75 lakh, 90 lakh. Reverse working, 1 lakh 60,000. MPS 75 by 1 and 90 by 60. P multiple balancing figure, again 2 decimal, we'll keep it. P multiple balancing figure. 8.98 and 31.65 are the P multiple level. 8.98 and 31.65 is the P multiple level in the question. This is the information. Beyond this, I'm going to quickly do a discussion. I don't want to spend time beyond this. Now, exchange ratio on the basis of EPS and MPS. On the basis of EPS and MPS. So, EPS base values are, the EPS values are 8.35 and 4.74. We will issue 4.74 is to 8.35. That is 60,000 shares into 4.74 by 8.35. You will see the number of shares issued here. 60,000, 4.74, 34,060 shares. 34,060 shares. Second part, on the basis of MPS, 75 is to 150. Exchange ratios 150 is to 75, 2 is to 1. Put together 2 is to 1, and then there are weights attached. 1 lakh 20 weights are attached. Finally, you will issue 85,624 share. You will issue 85,624 share. EPS 8.35 is to 4.74. MPS 75 is to 150. Once this is issued, I go back to the table. My EAT total number of equity share 1 lakh plus 85 624. EPS 2 decimal divide 6.03, same P multiple 8.98, and that's all. MPS. I really don't have much to explain beyond this. 54.15. The price will be 54.15. It's beyond this. It's a self-explanatory question. I really don't want to spend time on this. 54.15, 6.03. In the ICA solution, I think there is some mistake in the EPS number. Some error was there. I've rectified them. And this is the computation. One thing is data on debtors turnover ratio is to be ignored. That is wrong. That has to be ignored. Otherwise, you will get a different answer. Because if you do debtors turnover ratio, you will get a different sales number. With this, question 12 gets over. If there are any doubts, you can let me know. Okay, we move to question 13, a question which needs only discussion. Solving is not needed. On 1st April, ABCMF has the following asset and prices at 4 p.m. Shares of ABCDE, number of shares, market price, number of units. NAV of the fund. NAV is all assets minus liability. All assets is multiply 20,000 into this, into this, into this, into this, into this. Put a total, divide by 16 lakh. This number, there is an error. It has to be 238.10. There's an error there, 238.10. I just need to add up everything and divide by 16 lakh, 238.10. Then a person comes with a check of 2 crore. If he comes with a check of 2 crore, I have to give him units. 2 crore divided by 238.10. I have to give him 2 crore divided by 238.10. New units have to be given. A person is coming with a check 83,998.32, and with this 2 crore I buy extra shares at what price is not given, so I assume at the closing price, which is 528.80, 36,000. I hope you have already read the question and all. 528.80, 36,000 into 528.80, 1 crore 90 lakh 36,800. So I'll be left with cash. So my revised question will look like this. Remain same, extra 36,000. Cash is there. Value goes up, units go up, NAV remains same. NAV remains same, 238.10. We just got more money, more funds, more units, more shares, but NAV remains same, 238. Then if the price changes, obviously NAV will change. Now you need to multiply with the new share price. Same table, but it will not be 39.4, it will be 40.6. For B Limited, it will be 1027.4. C Limited, it will be 581.6. D Limited, it will be 1343, and E Limited. Now ICI solution, ICI RTP, they made a typing mistake in CDE value. That is when they drafted the question, they have by mistake given wrong numbers. In the solution, they have taken the right number. So I've changed the question itself, and this will give me the new NAV. That's all. Very simple calculation. Nothing much is there. We would have taken some 2-3 minutes only, because I feel that is a very simple question. Just discussion is sufficient. Some question everything will do. Some question only discussion is sufficient. Clear? Any doubts are there, you can let me know. Okay, another question where the concept of ratio analysis will be used. Following financials are available for PQR Limited: 8% debenture, 10% bond in bracket 2007, equity shares, reserves and surplus, total asset, asset turnover ratio, effective interest rate, effective tax rate, operating margin, dividend payout ratio, current market price, required rate of return of investor. You are required to draw income statement, sustainable growth rate. This was there in our study mat question as well. There they asked extra things. Here they've asked only the income statement and the sustainable growth rate. Their valuation of share was also asked. Here income statement will start with sales. where I have asset turnover ratio. What is asset turnover ratio? Sales by asset. Asset turnover ratio. Right. Note 1, computation of sales. Asset turnover ratio. Sales by asset 1.1 is equal to 600 by asset. Sorry, sales by 600. Sorry. Sales by 600 and sales is 660. Sales is 660. Operating margin 10%, which means expenses 90%. Expenses 90%. EBIT 66. Interest is little tricky. They have given 8% debenture, 10% bond. So ideally, I should do 8% debenture into 8%, that is 125 into 8%, and 50 into 10%. This is the ideal calculation, but there's an effective interest rate 8%. How can effective be 8 when one is 8, another is 10? Maybe some of the bond were issued in between the year, or the debenture were issued in between the year. I have no clarity. So they have said we will add 125 and 50. So interest is 175 into 8% directly. Right. 175 into 8% directly, rather than taking 125 into 8% and 50 into 10%. This is a place where student can make mistake. 14. EBT 52. Deduct tax. Beyond this, very simple, 20.8. EAT 31.20. EAT is 31.20. In this, we have paid 1/6 as dividend. Dividend payout ratio 16.67%. So in this, dividend is 1/6, 31.2, 1/6, and balance is retained earnings 26. This is income statement. Now growth rate is asked. Growth rate, you should be aware of this formula. ROE into retention ratio. ROE is EAES, ratio analysis understanding, divided by equity into retention. EAES is PAT, no preference dividend is there. EAES is 31.2. Equity is 100 plus 300. Share capital plus reserves and surplus by 400 into 100 to express in percentage. Retention is 100 minus payout ratio. 100 minus payout ratio, 7.8% into 83.33%. 6.5% is the growth rate. With this, my discussion on the RTP is over. The theoretical question I'm not discussing, but theory as such predominantly will come from only specific chapters, which I've already told you guys. So you focus on those chapters. Chapter 1, Chapter 2, your securitization chapter, security analysis chapter, and your last chapter, which is your startup finance. With this RTP is over. Any doubts, any clarification here, you can just type it here. Thank you, friends.